Welcome back to OptionsInsiderHQ. Today, we're exploring the covered call strategy, a popular method for generating additional income from your stock holdings. So, what is a covered call? It's a strategy where you sell a call option on a stock you already own. This allows you to collect a premium from the option buyer. In return, you agree to sell your stock at the strike price if the option is exercised. Implementing a covered call is straightforward. First, you need to own at least 100 shares of the stock. Then, you sell a call option with a strike price higher than the current market price, usually for a near-term expiration date. For example, let's say you own 100 shares of stock XYZ, currently trading at $50. You sell a call option with a strike price of $55, expiring in 1 month. You collect the premium, say $2 per share, for a total of $200. The main benefit is the income from the premium. However, if the stock price exceeds the strike price, you must sell your shares at $55, potentially missing out on higher gains. If the stock stays below $55, you keep the premium and your shares. To maximize success, choose stocks with low volatility and consider writing calls with a strike price 5 to 10% above the current price. Also, ensure you're comfortable with the possibility of selling your shares. That's a wrap on covered calls. If you found this video helpful, please like, subscribe, and hit the bell icon for more trading strategies. Happy trading!